The order goes through at 9:31 a.m. Eastern. Not a small order, not a hedge fund rebalancing. China's State Administration of Foreign Exchange initiates the sale of $1.1 trillion in U.S. equities, every American stock in their portfolio, simultaneously. This is a simulation. But the holdings? Real. The market mechanisms? Pulled directly from Federal Reserve data and trading systems documentation. The trillion-dollar figure? That's China's actual estimated position in U.S. stocks as of 2024. Your retirement account, your pension, your ability to get a mortgage next month, all connected to what just hit the market. Most people think the first casualty would be stock prices. They're half right. The real damage happens in a market most Americans don't even know exists. It breaks in a way that even the circuit breakers weren't designed to handle. By hour 4 of this simulation, the Federal Reserve faces a decision with no good options. Not about whether to intervene. They have to intervene. The question is which market to save first, because they can't save both. In a trading room in Chicago, a quantitative analyst is staring at a number that shouldn't exist. It's not that the number is wrong, it's that the model says this number is theoretically impossible. This is what happens when the second largest foreign holder of U.S. assets decides to exit all at once. Here's the actual mechanism. China holds approximately $1.1 trillion in U.S. corporate equities through various state investment vehicles. The State Administration of Foreign Exchange, China Investment Corporation, sovereign wealth funds. It's spread across 847 different stocks: technology, finance, manufacturing, energy. When the sell order executes, it doesn't happen through a single broker. That would be impossible. Instead, it's distributed across 23 different institutional trading desks simultaneously. Each receives instructions to liquidate their portion. Market orders, not limit orders, meaning sell at whatever price the market will bear right now. The first trades execute in milliseconds. Microsoft, Apple, JP Morgan, Exxon, 50 million shares, 80 million shares, 120 million shares. The volumes are staggering. On a normal day, Apple trades about 50 million shares total. In the first 90 seconds of this scenario, 180 million Apple shares hit the sell side. Here's what most people miss. Stock exchanges have circuit breakers designed to pause trading if prices move too dramatically. But these circuit breakers work on individual stocks. When hundreds of stocks are all being sold simultaneously, the circuit breakers don't coordinate. They trigger independently. By 9:34 a.m., trading is halted on 47 different stocks. Not because of panic, because the automatic safety systems detected abnormal price movements. Apple drops 8% in 3 minutes. Microsoft falls 7%. Goldman Sachs down 11%. The circuit breakers engage exactly as designed. But there's a deeper problem. Those circuit breakers pause trading for 5 minutes. When trading resumes, the sell orders are still there, still waiting, still massive. The circuit breakers bought 5 minutes. They didn't solve anything. A trader at a major investment bank in New York runs a calculation. Current sell pressure, approximately $1.1 trillion. Normal daily trading volume across all U.S. stocks, roughly $500 billion. The sell order is more than twice the size of a typical entire day of trading. And it's all happening in one morning. She sends a message to her risk management team. 3 words. We have a problem. Now, here's what surprises most people. The stock market can actually absorb this. It won't be pretty. Prices will crater. Retirement accounts will drop 15, 20, maybe 25%, but the market itself will function. There are buyers at some price, always. The real break happens in the Treasury market. Here's why. When institutional investors see $1.1 trillion in stocks being dumped, they make an instant calculation. If China is selling equities, what else are they selling? China holds $850 billion in U.S. Treasury bonds. The rational assumption, those are getting dumped too. So money managers do what they're trained to do. They front-run the anticipated sell-off. They start selling Treasury bonds before China does, just to be safe. By 9:45 a.m., the Treasury market is moving in ways it's not supposed to move. The 10-year Treasury yield jumps from 4.2% to 4.7% in 11 minutes. That might not sound dramatic. In the Treasury market, it's an earthquake. Treasury yields normally move in increments of 0.01%. A half-point move in 11 minutes is a structural event. A portfolio manager at PIMCO, one of the world's largest bond funds, sees the movement. She doesn't know what caused it yet. She just knows something is catastrophically wrong. She makes a decision. sell 20% of the fund's Treasury holdings, not because she wants to, because if this continues, redemptions from her fund will force her to sell at worse prices later. She's not panicking. She's being rational. The problem? 400 other bond managers are making the same irrational decision at the same moment. Day 1, hour 2. The Federal Reserve's trading desk at the New York Fed receives data feeds that look like errors at first. Treasury yields moving parabolically. Stock circuit breakers triggering in waves. Trading volumes at 340% of normal. An analyst double-checks the data. It's not an error. She picks up a phone that connects directly to the Fed chair's office. The conversation lasts 90 seconds. At the end, 4 words. Activate the emergency protocols. Here's what those protocols allow. The Federal Reserve can buy unlimited quantities of Treasury bonds to stabilize prices. It's called quantitative easing when it's planned. It's called emergency intervention when it's happening in real time during a crisis. At 10:47 a.m., the Fed announces it is purchasing $300 billion in Treasury securities immediately. The buying starts within minutes, automated, aggressive, designed to put a floor under Treasury prices. It works. Treasury yields stop rising, then slowly start falling back. By 11:15 a.m., the 10-year yield is back to 4.4%. Still elevated, but no longer in free fall. But there's a cost. Every dollar the Fed spends buying treasuries is a dollar created out of thin air. It's not taxpayer money. It's new money. The monetary base just expanded by $300 billion in 90 minutes. That has consequences, inflation consequences, but that's a problem for later. Right now, the immediate crisis is contained in the Treasury market. The stock market? That's a different story. The Fed doesn't buy stocks. It's not legally authorized to. So while Treasury bonds are being supported, equities are still in free fall. By noon, the major indices tell the story. Dow Jones, down 2,847 points, 11.2%. S&P 500, down 487 points, 9.8%. NASDAQ, down 1,653 points, 13.1%. The circuit breakers for market-wide halts haven't triggered yet. Those require a 7% decline. The S&P crossed that threshold at 10:22 a.m. Trading paused for 15 minutes. When it resumed, the selling continued. A retirement account holder in Ohio logs into his 401k around 12:30 p.m. He's 58 years old, planning to retire in 4 years. He lost $124,000 in 3 hours, not because he made bad investments, because the market absorbed a $1 trillion sell order that had nothing to do with the value of the companies he owns. He doesn't sell, not yet. He's been through downturns before. 2020, he knows panic selling locks and losses, but he screenshots the balance, just in case he needs to remember this moment later. Meanwhile, something else is happening that won't show up in headlines until tomorrow. A community bank in Iowa makes a margin call. They have a commercial client who borrowed $3 million against a stock portfolio to expand his business. The loan agreement requires the collateral to maintain a certain value. When the portfolio drops 12%, the collateral falls below the threshold. The bank sends a notice. Deposit $400,000 in cash within 24 hours, or the bank will liquidate the collateral. The client doesn't have $400,000 in cash. That's why he borrowed against stocks in the first place. He has 2 options. Liquidate the stocks himself at catastrophic prices, or default and let the bank do it. Either way, more selling is coming. This is playing out at thousands of banks simultaneously. Every margin loan in America just became riskier. Some will default. Those defaults create more selling, which creates more margin calls. The loop is forming. Day 1, 4 RPM. Markets close. The final numbers: Dow down 9.7%, S&P 500 down 8.9%, NASDAQ down 12.4%, $4.2 trillion in market value erased in one day. The 8th largest single-day decline in U.S. stock market history. But it's not panic. Not yet. Financial news networks are calling it a technical sell-off driven by foreign liquidation. Analysts are saying the fundamentals of the companies haven't changed. This is a liquidity event, not a value event. They're technically correct. But technically correct doesn't matter if your retirement account is down 9%. A financial advisor in Seattle gets 47 phone calls between 4 p.m. and 7 p.m. Every caller asks some version of the same question. Should I sell? His answer is consistent. This appears to be forced selling by a foreign entity. The underlying companies are still profitable. Selling now means locking in losses. Most clients accept this. 2 don't. They insist on liquidating their equity positions, moving to cash. The advisor processes the orders. He doesn't argue. It's their money. But he knows what this means. If enough people make that same decision, tomorrow will be worse than today. Day 2. Markets open. The first trade on the S&P 500 is down another 3% from yesterday's close. Not because of new information, because overnight, investors had 16 hours to process what happened and decide how they feel about it. Many decided they feel risk-averse. A pension fund in California has a problem. They're required by law to maintain a certain ratio of stocks to bonds. Yesterday's sell-off knocked their stock allocation down significantly. Normally, they'd rebalance by buying more stocks. But the fund manager makes a different decision. He doesn't know if the selling is over. What if China isn't done? What if other foreign holders start liquidating too? He decides to wait. Let the market stabilize first. He's being prudent. But his prudence means he's not buying. And if pension funds, historically the most stable long-term buyers, aren't buying, who is? Hedge funds are. But not the way you'd expect. They're not buying and holding. They're buying the dip and selling minutes later, taking advantage of volatility. It provides liquidity, but it's not stabilizing. It's extracting profit from chaos. By 11 p.m., the market has stabilized somewhat. The S&P is down about 4% from yesterday's close, but it stopped falling. A floor seems to be forming. Then someone posts something on social media that changes the psychology. A widely followed market analyst tweets, "If China liquidated 1.1T in equities, the logical next step is liquidating Treasuries. The real crisis might not have started yet." The tweet gets 240,000 views in 90 minutes. It's speculation. But it's informed speculation, and it activates a fear that was dormant. Treasury bond yields start rising again, not as dramatically as yesterday, but steadily. The implication? Investors are starting to price in the possibility that China dumps their $850 billion in Treasury bonds next. A bond trader in London makes a calculation. If China sells $850 billion in Treasuries, and the Fed has to buy all of it, that's $1.15 trillion in total. Fed intervention in 2 days. The monetary expansion would be unprecedented outside of wartime. What does that do to inflation? To the dollar? To interest rates long term? He doesn't have answers, but he has a portfolio to protect. He reduces his Treasury holdings by 15%, just in case. Day 3, China makes an announcement through official state media. The message is carefully calibrated. Recent portfolio adjustments completed. No further liquidations planned. Is it true? Nobody knows for certain. But the market desperately wants to believe it. Stocks rally. The S&P opens up 2.8%. By midday, it's up 4.1%. Headlines call it a weight relief rally and a dead cat bounce in the same breath. The metaphors contradict. The uncertainty is palpable. A wealth manager in Boston talks to a client who's 63 years old. The client's retirement account is still down 6% from where it was 3 days ago, even with today's rally. The client asks, "Should I move everything to bonds? At least I'll stop losing money." The wealth manager explains, "Bonds are actually riskier right now. If Treasury yields keep rising, bond prices fall. You'd be selling stocks after they've already dropped and buying bonds that might drop next." The client doesn't love this answer, but he accepts it. He's staying invested. Not everyone does. A report from a major brokerage firm shows individual investors withdrew $18 billion from equity mutual funds in the past 48 hours. It's not a massive exodus, but it's a signal. Retail investors are getting nervous. Meanwhile, something is breaking in the corporate bond market that almost nobody notices. A mid-sized manufacturing company in Tennessee planned to issue $200 million in corporate bonds this week. They need the money to refinance existing debt. The company is healthy, profitable, good credit rating. But when they go to market, there's a problem. The investment banks that normally buy these bonds to resell them are suddenly risk-averse. They offer to buy the bonds, but only at a much higher interest rate, 7.2% instead of the expected 5.8%. The company's CFO runs the numbers. At 7.2%, the debt service becomes problematic. It's doable, but it strains cash flow. He postpones the offering. They'll try again in a few weeks. Hope the market calms down. Across the country, 47 other companies make similar decisions that week. Bond offerings get postponed, not canceled, just delayed. This doesn't make headlines, but it matters. Those delayed bond offerings mean delayed expansions, delayed hiring, delayed investments. The economic impact is real, just not immediate. Day 7. The market has stabilized in a new range. The S&P 500 is down about 5.5% from its pre-crisis level. It's not recovering to previous highs, but it's not collapsing either. A new equilibrium has formed, but the equilibrium is fragile. Trading volumes are still 40% above normal. The VIX, the market's fear index, is at 31. Normal is around 15. Everyone is on edge. A portfolio manager at a large mutual fund describes the mood. We're not in crisis mode anymore. We're in elevated alert mode. Everyone's waiting to see if the other shoe drops. The other shoe they're worried about, China's Treasury bonds. Day 10. China makes a second announcement, this one less formal. A statement from a central bank official at a conference. In Beijing, China's holdings of U.S. Treasury securities remain an important part of our foreign exchange reserves. We have no current plans for significant changes. The words are diplomatic. The subtext is clear. We're not selling the treasuries. Treasury yields stabilize, then start dropping slowly. By day 14, the 10-year yield is back to 4.3%, still elevated from the pre-crisis 4.2%, but manageable. The acute phase of the crisis is over. Now comes the adaptation. Not everything stayed broken. A quantitative hedge fund in Connecticut actually profited from the chaos. They had algorithms designed to detect massive liquidation events and buy the dip systematically. Over 6 days, they bought $2.7 billion in stocks during the panic and sold them for a 12% average gain when prices recovered. They made $324 million. Some people are furious about this. Others call it providing liquidity when markets needed it most. Both perspectives are partially true. An index fund manager at Vanguard describes what happened from his perspective. We didn't change anything. Our funds are designed to track indices. When prices dropped, we bought more to maintain allocations. When prices recovered, we were positioned for it. Passive investing works precisely because it doesn't react to noise. Investors who stayed invested recovered most of their losses within 3 weeks. Those who sold at the bottom and moved to cash locked in losses that became permanent. A 64-year-old teacher in Oregon sold 40% of her equity holdings on day 2, moved it to a money market fund. She watched the market recover without her. 3 weeks later, her account is still down 4%, while the market is only down 1.5%. The difference, that 2.5%, represents $31,000 she won't get back. She knows it was a mistake now, but the decision felt rational in the moment. That's the cruelty of panic selling. It always feels justified at the time. Some corporations adapted. A pharmaceutical company in New Jersey had planned to repurchase 500 million of its own shares this quarter. When the market crashed, they accelerated the program, bought their own stock at discount prices. When the stock recovered, the company's balance sheet looked better. The CEO describes it simply, "We had cash, our stock was undervalued." That's exactly when buybacks create shareholder value. But not everyone could adapt. Small community banks faced a problem. Their commercial loan customers with margin loans defaulted when collateral values crashed. The banks had to liquidate the collateral at the worst possible prices, crystallizing losses. A bank in Nebraska took a $4.7 million loss on 3 defaulted margin loans. It's not enough to threaten the bank's solvency, but it's enough to hurt. They're tightening lending standards, being more conservative, which means local businesses will find it harder to borrow. The impact is diffuse, not dramatic, but real. A small manufacturing business in Wisconsin that was planning to borrow $800,000 to buy new equipment gets denied. The bank's lending standards just changed. 6 months ago, this loan would have been approved easily. Now, too risky. The business delays the expansion, delays the hiring of 8 new workers. The jobs that would have been created simply don't materialize. This is happening in thousands of communities simultaneously. The crisis didn't destroy the economy, but it made credit tighter, risk tolerance lower, investment more cautious. Day 30, markets have largely stabilized. The S&P 500 is down 2.1% from pre-crisis levels. Most individual retirement accounts have recovered to within 3 to 4% of their previous highs. But some things changed permanently. The Federal Reserve now holds $300 billion more in Treasury securities than before. That money creation has consequences. Inflation ticks up slightly, 3.1% to 3.4% over the next quarter. It's not hyperinflation, but it's movement in the wrong direction. The Fed faces a dilemma. Raise interest rates to combat inflation, or keep rates low to support the recovering market? There's no perfect answer. They choose a compromise. 1 quarter-point rate increase, enough to signal concern about inflation, but not enough to choke off recovery. Corporate America makes strategic decisions. CFOs at major companies increase their cash reserves. Instead of running lean balance sheets optimized for efficiency, they're building buffers, just in case. This means $340 billion in corporate cash that is sitting idle instead of being invested in growth. It's insurance. It's also a drag on productivity. The average American 401k is now holding 8% more in bonds and 8% less in stocks than before the crisis. Not because of deliberate rebalancing, but because of panic selling that never fully reversed. That shift means retirement accounts will grow more slowly over time. Lower returns, longer working years for some people. The effects compound over decades. An actuary at a pension fund runs projections. The market disruption reduced the fund's expected 30-year returns by 0.3 percentage points annually. That sounds trivial. Over 30 years, it's a 9% difference in total value. For a $10 billion pension fund, that's $900 million that won't exist. Some retirees will work an extra year. Some will reduce their standard of living. The pain is distributed, delayed, and difficult to directly attribute to this event. But it's there. International investors make their own calculations. A sovereign wealth fund in Norway reduces its U.S. equity allocation from 40% to 35%, not because U.S. companies are less valuable, because the risk of another foreign liquidation event just became more concrete. When enough foreign investors make similar adjustments, it creates a permanent reduction in capital flows to U.S. markets. Smaller, but measurable. Approximately $120 billion less in annual foreign investment. That's $120 billion in capital that won't fund American businesses, won't create jobs, won't drive innovation. It finds other markets instead. Zoom out from the 30 days. What does this simulation actually reveal? It shows that global financial markets are robust but not invincible. They can absorb trillion-dollar shocks, but not without cost, not without scars. The system that allows China to invest $1.1 trillion in American companies is the same system that makes those investments vulnerable to geopolitical decisions. The interconnection creates efficiency and risk simultaneously. You can't have one without the other. This isn't about whether China would actually liquidate this way. The simulation is hypothetical, but the fragility is real. Every pension fund, every retirement account, every corporate bond, every mortgage, they're all part of a system that assumes normal levels of trading, normal volatility, normal behavior. When that assumption breaks, even temporarily, the ripples spread in ways the system isn't designed to absorb cleanly. Remember that order going through at 9:31 a.m.? In the simulation, the gap between markets are functioning normally, and the Fed is creating $300 billion in emergency liquidity was about 90 minutes, not instant. But fast enough that traditional market mechanisms couldn't fully absorb the shock without government intervention. The only hypothetical part was the trigger. The mechanisms, the margin calls, the circuit breakers, the Treasury market dynamics, the pension fund rebalancing rules, all real, all active, all ready to cascade if stressed sufficiently. The real question this simulation raises isn't whether this exact scenario will happen. It's what other concentrated positions exist in the global financial system that could create similar cascades if liquidated quickly. China's U.S. equity holdings aren't the only single point of exposure. They're just the one we examined. What else is out there? What other trillion-dollar positions are quietly embedded in the system, stable until they're not? We optimized for interconnection. We got efficiency. We also got systemic fragility. Whether that's the right trade-off depends on how you value stability versus returns. There's no objectively correct answer. But after watching this simulation, you probably have a more informed opinion. The distance between stable and crisis might be shorter than the time it takes for a massive sell order to execute. If this type of economic simulation interests you, the algorithm will show you similar videos. And here's the question I'll leave you with. How many other foreign holders are sitting on positions large enough to create similar cascades? And how confident are you that none of them will ever have reason to liquidate?